So now we know how interest rates are determined using both the liquidity preference theory and the loanable funds theory. But the point is that there exist many money markets, which means that there are numerous interest rates in an economy. There are interest rates on savings in banks, in the treasury bill market, on credit card market, in the mortgage market, and so on. So interest rates may differ for quite a few reasons. One reason is the risk factor. So the point is that the greater the risk of default on a loan, the higher the interest rate will be charged. Say if I'm a sole trader and I need a loan, the bank will charge me a higher interest because I run a small business and there's a greater risk of defaulting on a loan. On the other hand, if I was an MNC or a large-scale company, the probability that I default on a loan is quite less, which means a lower interest rate will be charged. On the other hand, the time factor also matters. As the length of the term of a loan increases, a higher interest rate is necessary to compensate the lender. If I'm taking a loan for 2 years, which means that I'll pay it back within 2 years, a lower interest rate will be charged. But if the term of the loan is 10 years, which means that the bank's money will be with me for 10 years, a higher interest rate is charged to compensate for to compensate the lender. Then there are administration costs involved. Admin costs. Simply, the higher the administrative cost, the higher will be the interest rate. Administration costs are higher if the loan amount is quite large. Then interest rates differ due to imperfect knowledge. Borrowers may be aware that they could cut their interest rate payments by, let's say, changing their credit card provider. So, in that way, there exists imperfect knowledge, which leads to some borrowers paying higher interest. Imperfect knowledge. So, these are just a few reasons why interest rates differ in the money markets. Then let's talk about nominal interest rates and real interest rates. So nominal interest rates are those interest rates that have not been adjusted to inflation. And real interest rates has been adjusted for inflation. Adjusted for inflation. So this means that the formula for the real interest rate is nominal minus inflation. So for a lender or a saver to make a net return, the nominal interest rate must exceed inflation so they do not lose in real terms. And let's talk about the relation between interest rates and national income. So when we were discussing aggregate expenditure, we said that the interest rate and the marginal efficiency of capital are inversely related. So if I sketch MEC, a rough sketch, this is what it would look like. Let's say this over here is interest rate, and this over here is investment. So since the investment is inversely related to the interest rates, this is what your MEC curve will look like. So investment in capital is therefore very sensitive to changes in interest rate, because for an investment project to be profitable, the MEC needs to exceed interest rates. Then from a producer's point of view, producers usually hold stocks of inventory to meet fluctuations in demand and to avoid shortages of input in the future. So the opportunity cost of holding stocks of inventory is the interest foregone. So investment is therefore very sensitive to changes in the interest rate. So basically, as interest rate falls, let's do it the other way around. As interest rates rise, investment falls, and when investment falls, AE falls, and when AE falls, your national income falls. So a rise in interest rate also raises the cost of purchasing durable goods, consumer durable goods. So this also means that consumption will also fall, so that AE falls and then Y falls again. So this is it for interest rates. In the next video, we'll talk about the Fisher's hypothesis and the quantity theory of money.